Welcome to Switzer Investing. I'm Peter Switzer, and on tonight's show we look at 4 stocks in particular: Audinate, Qantas, Megaport and NXT. Now, helping me suss out these companies is Julia Lee of Berman Invest, Jun Bei Liu of Tribeca Alpha Plus Fund, and doing the charts analysis is Michael Gable of Fairmont Equities. And then I look behind how the US-based funds with 2 listed fund products on the local stock market, WCMQ and WQG, have done so well. The co-founder, Kurt Winrich, explains WCM's investing technique, which helps his team select some of the best companies in the world. Interestingly, they pick and dump stocks based on the company's culture and their growing competitive edge. Well, that's the show. Let's kick off with Julia Lee of Berman Invest. Hi, Julia.
Hi, Pete. How are you doing?
Very good, very good. Now let's kick off. Let's not muck around with niceties. You and I just go straight to stocks. And what I want you, I'm interested, if you don't run your eye over, is a company called Audinate or AD8. What do you think of this company?
Sure. This is a company that looks at the digital networking of audio. And obviously with COVID-19, there has been some impacts. But the good news is that the last couple of updates that this company has given for the third quarter and the second quarter, business is back to those pre-COVID-19 levels. So that's nice to see. In particular, the third quarter update was a very strong one. And I think it was boosted by some new products. So when you have a company, sometimes there are trigger points for a share price move. And these can be things like new management, new strategy, and sometimes it's a new product. And in this case, they launched a new adapter, which was a Bluetooth and a USB-C adapter, which helped boost sales as well. So I guess a big question for investors was that a one-off boost or is that likely to continue? But I think this company is quite interesting in the way it's doing things and the traction it has, as well as those new product launches. So yeah, I think this one looks quite interesting for the medium to long term.
Okay, this is a company I've asked you about in the past, and fortunately, it actually has started moving in the right direction. Megaport, what do you think of Megaport right now?
Yeah, I think, Pete, last time we spoke about Megaport, I said I was pretty happy owning it around $13, and I think now it's back to $14. So it has been on the move, which is nice to see. I do think that it is due for a bit of a pullback, so I'd probably be more comfortable owning it with a 13 in front of it. So I'd just wait for a little bit of market weakness to pick this one up. But you know, this is one of those structural trends where we are moving to the cloud, and in particular, we are seeing, I guess, data centers doing well as well. But this is all about, you know, being able to transfer data from data center to data center, which is an interesting proposition. Usually when we look at Megaport, it gets compared to NXT. And I guess both are good, but what Megaport allows you to do is to connect to different data centers all around the globe. So it's not just about accessing and moving data from your computer up to the cloud, but also from data center to data center, which I think is good when we are so reliant on the cloud now.
Okay, now what I want you to do now, Julia, is do a bit of method acting, because that means you can't be yourself anymore. I want you to put yourself in other people's shoes, only for a moment. Now, your shoes are momentum shoes. You look for great companies on the rise and you get in, you make your money and you get out. That's Julia Lee. But other people watching this show might be long-term investors who want to buy companies of the future, ones that might not necessarily do well in the short term, but if you give it 4 or 5 years or so, they're going to be the great companies of the future. Do you think a company like Megaport could be that kind of company of the future?
Yeah, I think both Megaport and NXT, you know, this is a structural trend. So when I look at momentum, I look at momentum in terms of earnings as well as in terms of share price, because just looking at one or the other isn't enough. Usually looking at both gives you a stronger signal and more confidence to enter into the stock. But this is that structural trend where we are more data reliant, as well as moving a lot of that data to the cloud as well. And that structural trend certainly has legs. The big question for investors investors is whether we've seen a pulling forward of that demand and growth from the future, and whether, you know, that's now priced into the stock. I think below $14, I would be very happy to own Megaport. And look, I think it's a long-term story. So while we talk about tech companies and there are some sexy ones that sort of come and go, I think Megaport and NXT, they're riding this structural trend that we have to use more data and also that move to the cloud.
That was very good method acting, Julia. I'm proud of you. Okay, let's go to an easier one for you, whether you like it now or not, or for the future, is Qantas. What do you reckon?
So we hold Qantas in the portfolio, and this one, look, I think it's about a post-COVID-19 play, and I think it's all about what Qantas looks like post-COVID-19 and when the borders are open and things are back to more of a normal level. What does it look like? Is it in a better place competitively or in a worse place? What we've seen from airlines around the world is that they're slimming down. They're sort of closing their lounges. They're doing the bare minimum because it's quite a difficult place to be, whereas Qantas, I think, has its eye on a longer term strategy. So I think that once COVID-19 has passed, it's actually going to have more market share, better loyalty, and be in a stronger position. So I think Qantas is all about that post-COVID-19 story. And if you're happy to own it for a few years, I think this one is, I guess, a no-brainer.
Okay. Now, last time we talked, you said you liked Altium again, and you'd bought Altium. What about Appen? That was, you know, one of the wax stocks that came around the same time. Well, is Appen the company that's going to benefit from when the world gets back to normal, or has the best of this company been behind it?
Yeah, I think Altium's a little bit different in that it's been impacted by COVID-19, and I think we're starting to see a bit of a bounce back. There might be one more profit downgrade out there, but we're starting to see that path to normalization. So around the $27, $28 level, I think we were talking about it when it was about $27, looks quite interesting, and I'd be happy to start accumulating. Appen, though, I'm a little bit it is a little bit different. It has been impacted by COVID-19, and traditionally you've seen, you know, those big tech giants spending on Appen, whether it's something like Facebook or Google. But I guess there's a bit of a question mark whether we are starting to see a bit of product substitution there. So with Appen, I would prefer to wait until the earnings started the recovery path rather than getting in ahead of that, because I have lower confidence in what's happening within the business. So with Appen, yes, it looks cheap if it's going to bounce back to normal levels because the share price has fallen so much. But I have a bit of a question mark around that earnings recovery, which makes me unsure. So I'd prefer to see a couple of good updates coming through first. Okay,
now you can go back to being your normal self now. And is there a new stock that you've liked this week that you've added to your portfolio?
Yes, been watching those agricultural stocks for a while. So we've been a fan of Elders for a while, and we have had some Incitec pivot as well. And this week we've added Nufarm to the portfolio as well. I guess we talk a lot about commodity prices moving up, and certainly copper prices, iron ore prices have been moving up. And we sometimes forget about the soft commodities, but soybean prices, corn prices have been moving up very strongly as well. And growing conditions are looking very good. Here in Australia, we're coming into that winter cropping season. The soil looks moisturized or moist, and it's looking quite good.
Very agricultural, that was.
There's plenty of water around as well, so the summer cropping season is probably going to be pretty good. So Nufarm, its last update, the first 4 months of the financial year for Nufarm, they have a financial year which ends in September. Revenue was up by 17%, but importantly, each division was up on the previous corresponding period. So this one does report on the 20th of May, and there is an expectation that this one is on the recovery path. So Nufarm, and I think the whole agricultural space is looking quite interesting here.
Julia Lee, thanks for joining us.
Thanks, Pete.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Well, I'm catching up now with Michael Gable from Fairmont Equities. I've asked Michael to look at a number of stocks people have been asking me about, and one that was put to me in our Investor Strategy Day by Michael Wayne. Michael also then talked about on Thursday night's show, a company called Audinate. Good to see you, mate.
Thanks, Peter.
I didn't know much about this until Michael started talking about it, and I did notice it's done pretty well so far. But I'm curious to see what the charts are still saying about AD8.
Yeah, so look, it's had a pretty good run off the off those COVID lows. It seems to be one of the companies which has benefited from COVID. It's not a business that I was very familiar with either before today. But look, ultimately, when we look at the chart for AD8, it is still, I think, got an uptrend to it. So look, that's the positive. I think it's the first thing that you need to look for at a chart. Is it going from bottom left to top right? If it's doing the opposite, then you know, you're dusting your capital on day one. So look, it is heading in the right direction generally. Although what I've noticed on the chart is some very key, I guess, resistance and support levels. So firstly, at the top of the chart, I've put a horizontal blue line there, which indicates a major resistance at $9. So from the left-hand side, top left, we could see that earlier 2020, it hit $9 and was unable to make much headway beyond that. And then at the top right-hand side of the chart, we could see that most recently, at the early part of this year, again, it got to $9. Naturally, there was a bit of selling that kicked in and the shares fell away. My only concern there, though, is instead of just hovering under $9 and absorbing that selling, it has come back fairly sharply all the way back to $7. But then it's bounced again, and as we could see, some selling last week has kicked in close to $9. So at the moment, we've got a situation where it's trading around $8. $9 is clearly a problem for it, but most recently it's bounced off levels near $7. So essentially it's trading right in the middle of a very obvious range. So ultimately it's one of those situations where I think if you're holding it, there's no reason yet to be selling, but to buy it, you'd either want to wait for it to come back towards $7 just to get it at a cheaper level, or you'd at least need it to clear $9, get rid of all those sellers, and then you have a clear run. So ultimately I'm fairly neutral on this one. I think you can finesse a better entry point.
What I found interesting is that, you know, your first observation was this is a stock that's done well out of coronavirus, but ironically, it is a company that really does well when there are events and all that sort of thing, because they actually do have this sort of wireless connection, you know, electrical equipment and sound equipment and video equipment, which has been basically put on hold. And you can see, okay, it bounced out of its lows, but then went sideways for a while, and it started to rise on the reopening trade idea. And I guess the question is a bit like Webjet, is this the first leg up of the reopening trade? And if the company's heading in the right direction, there probably is another future. But I thought, when I looked at, I wanted to see whether you thought there was more upside or more probably sideways movement. Okay, great. Let's go to the next one. Now, Megaport is a company, it's Qantas, and Qantas, of course, is another one of these reopening trade type stocks. It has had a bit of a kick up, but I just thought, well, maybe it's a buying opportunity for someone who wants to wait a year or so when we will hopefully have international trade back to normal. So what are you saying?
Qantas is at I guess, a very interesting level here. I mean, these travel stocks, ever since the COVID lows, we've been in and out of some of these travel stocks, and look, they have been difficult. I mean, you sort of look back and you think, well, I could have probably done even better than what we have done if we'd sort of dealt with the volatility a lot better. But it's just a crazy sector at the moment. It gets a bit of a run, and then something happens like a lockdown or a rise in cases overseas, and then the whole sector comes off again. So you really need to be nimble if you're trying to play it shorter term. But longer term, I agree, they'll everything will eventually head down the direction where we're vaccinated and people are moving. And
there's no India problem or Brazil problem. Hopefully they'll go over the next year or so.
Yeah, so we know the direction. There's just massive speed bumps along the way, as we could see with this Qantas
Is it a good
chart.
entry price, do you reckon, at this point in time?
So again, look, I'm a little bit on the fence with this one, and I'll show you
You might
why.
know with splinters, mate. You're seeing the fence so much.
So look, there's quite a few lines on this chart,
Yeah.
but essentially what I'm trying to say is it's at a very critical juncture. I think there's very good support here around sort of 485. It's bounced off that. However, $5 used to be good support for the stock, and now it's hitting up against that and unable to go through. So we've got this little tug of war happening with Qantas. Does it want to head higher? Does it want to go lower? We're not sure yet, but what I have noticed is the price action over the last couple of weeks has started to tighten up. So it's going sideways. I think it'll resolve itself pretty soon. So what that means is if we get a nice big push back above $5, I'd view that as a big positive, and I think that will lead to a lot more momentum in Qantas. However, if we see it start to fall under 485, even 480, I'd say the thing's going to weaken off possibly to 450 before it even finds support again. So look, unfortunately, no clear answer right now, but I'm pretty sure this week, Peter, will see some resolution of this chart.
Okay, let's go to Megaport now. Now, my background with Megaport didn't know much about it at all. A few of our mutual colleagues thought it was a pretty good company. It went off the boil. Then I interviewed Bevan Slattery, one of the founders of Megaport, and he got me interested in it. And in recent times, it has gone for a nice rise, which means the people who listen to me don't think I'm a complete idiot. It's actually showing a bit of form. But what are the charts saying?
Look, we looked at this one together a few months or so ago, and we noted the downtrend, but that's over now, which is great. So, so firstly, if we have a look at the right-hand side, where I've put those diagonal blue lines, what I've indicated there is over the last few weeks, it's started to put in a higher high, a higher low. The range has tightened up in the right direction. So that was sort of the first indication that that something interesting was happening. And then a couple of weeks ago, it pushed beyond $13, which to me was the first sign that the downtrend's over. It's now going to start to do something. It's obviously had a cracking run in the last couple of weeks. Look, I don't know if there's short covering or what's going on, but longer term, this is very encouraging for the stock. Shorter term, if you're trying to find an entry point, I think that it looks very extended, in my opinion. So, in terms of
is that blue line kind of telling you that that's been a troublesome price for this to get through?
Yeah, exactly. So $15 is a major resistance level. And it's quite extended because it's where it started the most recent move. It's gone from $12 close to 15 and been up almost every day. So what I'd prefer to now see is a bit of selling coming near 15. I think that will naturally happen. And possibly over the next few days or so, you might see it just ease back, maybe closer to 13 again, have a bit of volume come out of it, and then that will give you your next entry point. So longer term, what we've seen is encouraging, but again, if you're trying to finesse a better entry point than $15, I think you can get it closer to 13.
Okay, they're my three I wanted you to run your eye over. What about your favourite one for this week?
So the stock that I've got here is Iluka. So it's a resources company. It's a greater than $3 billion Aussie resources company, mineral sands. So like, I suppose last time I was here, I think I spoke about Western Areas, and the time before that, BHP. So I know I've got a bit of a thing for resource companies at the moment, but they seem to be...
used to be. Historically, I've never seen you in that phase, but this is the cycle. The cycle.
Yeah. So Iluka's, I think, the next one that's on the move. We put a buyout alert on this for our clients last week. So what I want to show your viewers is on the right-hand side at the top, I've put a couple of horizontal lines just indicating the consolidation in Iluka. So what I mean by that is the shares jumped up at the end of March, and before attempting to go through the February peak, it just traded sideways. So again, it's just absorbing selling without getting sold down sharply, which I like. And then it was just a case of waiting for that selling to back off, and then it's able to make a move. So it started to do that last week, which I've circled. So again, we've got a nice uptrend preceding this breakout. So the trend's in the right direction, the sector's in the right area, and now it's breaking out to a new high, which a new high for the year, which I'm not afraid of. I've got no problem with that because all the sellers are gone and it should just go for a nice run here.
So when you support a company like Iluka and the charts are telling you this, I presume you also look to see whether the fundamental analysis also reinforces the idea.
Yep.
So what aspect of the economic cycle, the commodity cycle, does Iluka really work into? Like, if I remember rightly, ceramics and stuff like that, they use it for ceramics.
Ceramics, you've got rare earths. So all the sorts of things which
the trendy stuff that's been working.
The trendy stuff. So economies go up, people spend money. They spend money on things which need to be built by the mineral sands and the products that Iluka's producing. So look, they're in a great spot. The business is doing well. Look, with resource companies, I suppose with any companies, I don't fall in love with them while they're working out for me. Sure. I'm happy to go along with it, but we might be
a short-term relationship you're talking about. You're not married to these companies for too long.
If it's going up for another year or two, then I'll be happy to go up with it. But as we've seen with even the big boys like BHP and Woodies and Rio, if you hold them for a very long period of time, you actually don't really make any progress at all because these businesses are cyclical, and you need to always remember that.
Okay, that's a bit of both good investing and even relationship counselling.
Advice.
Just joking, from Michael Gable. And that was Michael Gable from Fairmont Equities. And now let's catch up with Jun Bei Liu of Tribeca Alpha Plus Fund. Well, thanks for joining us, Jun Bei Liu.
Peter, it's always great to speak with you.
Okay, so let's talk about these companies. I want to start off with Audinate, and I didn't know much about this until Michael Gable actually talked about in our Investor Strategy Day, and it seems like an interesting company. Have you looked into Audinate AD8?
Actually, we did. Last year was actually quite interesting given the market sell-off. All these sort of companies were sold off. So we saw that was a very interesting opportunity. Essentially, the company sort of provides its technology goes into all these entertainment sound systems of those entertainment events. So it's very leveraged to concerts and large scale sort of events around the world. And believe it or not, it's actually a market leader in that space globally. So the company listed a few years ago, but because it's so leveraged to those events and concerts and the like, COVID really just wiped out the entire earning. So last year looked very cheap. Now share price has done very well because it is a reopening trade. The problem is the earning has yet to return, and the price is actually really pricing in quite a bit. So it's somewhere in that whole sort of space. Do you rush out and buy it? Probably still got a bit of upside, but we really do need to see the earnings returning before you can actually really ascertain of how far it might go.
Okay, so listening to you and also looking at what Michael Gable said, it seems to me that if it does dip, it's probably a classic stock to buy on the dip, to maybe expect a nice return in a year or two when the world gets back to normal and big events are happening. Is that the kind of analysis you'd give?
Oh, absolutely. That's a really good analogy. If it has a dip, if a world suddenly have a sell-off again, this is one of the stock you should buy because earnings will grow enormously over the next couple of years.
Okay, so let's move to another one in the tech space. And I got onto Megaport purely because I interviewed Bevan Slattery, and he kind of showed me that this company has a lot of future, and I didn't necessarily think it would take off. And for a few months, I looked a bit like a nincompoop, but it now seems to be moving in the right direction. But I think you've always liked Megaport, haven't you, Jun Bei Liu?
Absolutely. This is another stock. If we have a sell-off, it's something that you just buy because in Australian market, we have very little exposure to the likes of cloud and the cloud computing, the 5G and the data growth, right? So, the only couple of company you can have exposure to is something like the NXT through the property play of the data center, or Megaport. Megaport is actually a very pure play to the leverage of the cloud growth. So this this company, it is a very expensive stock because it's growing really, really fast. The management execution early days has been incredible. It is the largest player in that the niche spot that they have invented globally, and its growth has been going very, very well. Now, of course, the company is not yet profitable, same as pretty much all these fast-growing businesses, but it is coming very soon, and it's about world dominance. And this company has invented its niche, and I think the future is enormous. It's hitting all the right spots in terms of all the all the data points, and I think the company in the next 12 months will do very well.
Yeah, it seems to me when Bevan explained it to me that, let's take, for example, the VRC, when Melbourne Cup comes around, a website like that needs enormous capacity to cope with the kinds of interest that would go to their website. But for most of the year, they don't need that kind of capacity. So a company like Megaport provides that capacity for those big events, those big periods when the traffic to your website could be huge.
That's right. Actually, that's a really good explanation. So yeah, a lot of time you don't really want to sign up for a whole year for all these capacity. Even for a large company, you launch a marketing campaign, you need this much bandwidth for this weekend, globally, simultaneous launch, and Megaport to you, just a phone call, $30 a month or $50 a month, you would get that done. So it's incredibly convenient to use.
Yeah. Pretty clever stuff. Now, the next company, we'll stay in the tech space, is NXT, which you brought up. And once again, this is a company I think that I bought to hold for the future. To me, it's like an infrastructure stock that we're always going to have to use NXT. Am I being too blinkered in my belief that NXT is a company that's going to continually improve?
I think you're right. And it's right, and NXT is a property trust of the future. Right now, we think about property trust as land and buildings and all of that, houses and stuff. But that one is for future infrastructure with a growth in data, growth in cloud computing, 5G demand for data. We don't see that slowing. So NXT is very leveraged to it. But our view is a little bit neutral. I'd much rather play Megaport because NXT is a property play, right? So it's about going out and land grab and buying as much as you can. So the capital outlay is very high. So whether you'll get the investment, we're not so sure because it's very long dated, and there are many companies in that space. So certainly it will give you that future proof of the earnings stream, but perhaps it's just a little bit uncertain in terms of how much return you really generate in the future. Yeah.
So to me, it's kind of like one of those slow growing blue chip type stocks, but won't give you the exciting returns that a racy person like you was always looking for. Okay.
Oh, I do have stable business in my portfolio.
Okay. All right. Let's go to a company that I think is best of breed, but it still has some challenges because of the coronavirus, and that's Qantas. So what's your view on Qantas?
Oh, I'm pretty positive Qantas at this point. So finally, we are here. We just started domestic traveling, and the bubble with New Zealand just being opened up. This company makes most of its money in domestic travel. Do remember that. So even though the global travel is not going to return in full capacity for some time, but domestic is most lucrative part of this business, and it's already picking up very, very sharply. So yes, we will have hiccup here and there about border closure and the like, but we finally almost here. So I think this business will do well. Share price has moved, but it actually has lagged quite a lot of reopening play because people want to see those earnings coming through. We think the next quarter, the earnings will look pretty big.
Okay. Jun Bei Liu, always great to see you. See you in a couple of weeks' time.
Thank you very much. See you soon.
And that was Jun Bei Liu. My final segment looks at the fantastic track record of WCM, the US fund manager that was brought to Australia by a company that I have a share in, Contango Asset Management. Now, Contango also manages my Switzer Dividend Growth Fund, and that's why I'm connected to them. The chart on screen shows how good WCM has been over a long time. And the next chart shows you how WCMQ, which is basically like an ETF version of WCM, has done so well over a 3-year period in Australia. Have a look at that chart. Now, my interview with Kurt Winrich explains why these particular funds that are listed on the Australian market have been great performers. Kurt, thanks for joining us.
Thank you. I'm sorry to be a little late, Peter. Had the wrong link, but that's how it goes these days.
Yeah, well, people of our young age, we sometimes can get the technology mapped out. But fortunately, the people you work with are really good at picking the tech companies that really have a lot of potential, don't you?
That's correct. I'm glad they are.
Yeah, and I'll tell you what, I recently heard one of your guys address a conference where I was doing a presentation myself, and the one thing I found fascinating was he said that, okay, our funds have exposure to tech companies in the digital space, but he also made the point, which I think shocked a lot of people, and that was, he said, the digital age is in its infancy. And
Yeah.
that kind of staggered me.
Yeah, that's an assessment that I think has a lot of validity. And it's funny coming from me. I don't know if you remember my background, Peter, but I was an electrical engineer in another century, and so I've been interested in tech for years. So to me, the digital age is my whole career, and yet I really do see what they're talking about. There comes a point in the future where not only is everything we work with digitized and connected, but, and this might be a little scary, even at some point, our bodies will be connected and digitized. So yeah, I think we'll look back on 2021, so the people younger than I, and think it was pretty primitive back here.
Yeah, I gotta say, the thought of your body and my body joining, Kurt, I don't want to go there, but I just prefer this technical connection we've got right now. Now look, for people, well, I should explain, WCM is a Californian-based fund, Laguna Beach, California.
Right.
Kurt was once upon a time the greatest surfer in America. I'm making that one up.
But one of my neighbors was, actually.
Okay, you can name names if you want to. But WCM has come to Australia about a little less than 4 years ago. That they've got two well-known listed products. One is a LIC, that's WQG. Another one is virtually an ETF called WCMQ. And they've performed fantastically since they've come to Australia on the Australian Stock Exchange. And they've got another product, which we'll talk about later in the presentation. But I think a lot of people need to understand the history of WCM and its investment strategy, because it's quite a unique investment strategy. And when I tell people that in particular, you care about the culture of a company, people are really fascinated in that. But why don't you just give us a part of the history of the company and the investment strategy, Kurt?
Sure, great. And I'll just start by making a connection to what you just said. The history has a different story, but nowadays we say that WCM stands for Why Culture Matters. And it really is the history of our firm that has led us to that conclusion. The firm was founded over 40 years ago. The original founder was what I sometimes call a solo act, who made all the decisions, made all the money, owned all the stock. And you can guess that the culture that is born out of that kind of an attitude tends to not include a lot of other people. And so talent would get hired because you need somebody to do the work, but then it would quickly find out it didn't have a place to go and would go out the back door at another firm, start their own. That happened numerous times until my partners and I were able to buy out the original owner in the late 90s. And we made a promise that we were going to build a culture that was different. Most of the time that meant doing things differently, but the objective was to say, we not only want to attract great talent, we want to keep great talent and let great talent do great things. And to do that, you have to share the wealth, you have to be transparent, you have to push equity down. So from one owner in 1976 to 4 owners in 1998 to 34 owners at WCM today out of a total of 70 people. That's a lesson that was learned in fits and starts. But the thing that got us, I think, really going was realizing that if that makes such a huge difference in people that would leave our company, people that would stay with our company, it's got to make a difference everywhere. And then when you look around, you find out that almost everybody that is a great investor believes that as well. So we started with U.S. domestic products, and then in the early 2000s, branched out to international and global. And like I said, now 70 people, about 4 different offices in the U.S., but the main one is Laguna Beach. and happy to have a great presence in Australia.
Okay, now tell us what is so unique about your investing style. I should actually say to people watching it in our financial planning businesses, you know, we have you guys and we have Magellan, because you're both very good fund managers, but you invest differently. And that's why we like having, you know, two different styles of investing for our financial planning clients. But tell us about what your investing style is.
Yeah, thank you. I think there are two main things to consider in our style. It has to do with what we think is important in a business that's going to make that business grow and give a return to its investors, which is, of course, what we're trying to achieve. The number one thing is you do have to think about competitive advantages, but we like to say you have to think of them differently than most people. It's pretty common to talk about a competitive advantage, to have one that's large. In fact, Warren Buffett gave the old moat metaphor to this thing years ago, and now you see it at Morningstar and everywhere else. What we think is important is not necessarily a big competitive advantage, but one that continues to get stronger. And so that's the number one principle of how we invest. We're trying to find businesses that are on the rise in terms of their competitive position, and even maybe more important, if you will, in terms of protecting the downside, which is something we do very consciously and very well. You do not want to own businesses that are losing their edge. So the bulk of our research is spent on it, trying to understand, how do you tell that a competitive position is strengthening? How do you tell that it's weakening? And then the next thing that connects right to that is, if you can answer the question, how do you tell that a competitive position is strengthening? The next question is, how do you tell if it's going to keep strengthening? If it's going to do that, not just for a year or two, but will provide a partner in a business for a decade or more, if you can. And we think the answer to that is, how does the culture fit in to that company's strategy, to their advantage? So the big idea for us is find a competitive position that's getting stronger, and find a culture, which is basically just the behaviors of the people in that company. Find a culture that supports that competitive advantage and helps it to continue to grow. And what you end up with here is a business that outdoes expectations, because these are not factors that are found in a DCF model. These are not factors that are found in any database. These are about people and their behaviors and staying ahead of their competitors. That's the kind of businesses we want to partner with.
All right, Kurt, so two questions on that. The first one is, and when I talk about your interest and care about culture, people instantly say, oh, people say to me, well, how do they do it? And I say, well, they've created their own IP, their own basically filters for culture, but you explain that more. But secondly, I think I want to give us an example of a company that you thought was a good company, you might have made money out of it, but over time, the culture filters said, you got to drop this company.
Yeah, one that comes to mind is a company out of the UK called Reckitt Benckiser. Reckitt Benckiser has been an interesting history for us, with some cultural ups and downs. And quite honestly, we've had a lot of learning out of that experience. Years ago, the company was extraordinary at acquisitions and consolidating in the home healthcare businesses and the products that go along with that. They had an interesting departure by both the CEO and the CFO within a few months, unexpected. Initially, that caused us to be wary of what was going on. So we actually did sell the position when we thought that the culture was actually damaged. A few years later, a new CEO came in that we were quite positive about. We gave him some time to actually work out how he was going to run the place, thought that we had a pretty good sense of it, rebought Reckitt Benckiser, made some money at it, but then found, to our surprise, that the new CEO quit again. And then we said, this is 2 times, we've got to figure this out. We dug pretty deep and found out that there were issues all the way at the board level that we aren't comfortable with. And so the idea of vetting the culture, not only in the leadership of the people, but in the people that pull the strings as well, has been the new learning lesson from all of that. So that's a company that we made some money on, but we've ended up not owning it because the culture's not as healthy as we thought it was.
So how have you created a filter for culture, or is it done one-on-one every time? But you must have at least a checklist of what is critically important.
It is mostly, though, one-on-one conversations. We have a dedicated culture analyst team here at WCM who feeds information into our normal business analysts, but all of it is based on extensive conversations. The tools that we use that are beyond that, or we have survey companies help us to understand by asking peers. Even in our conversations, some of the most enlightening information comes from talking to competitors. But the idea that we're looking for are three. We really are concerned that a culture be what we call adaptable, for one. We've found out from academic research and other places that cultures that have an external awareness tend to have much better business performance than those that are only internally aware. So this is an example would be to talk about a business that understands who its competition is and what they're doing, as opposed to the internally aware culture that simply says, we can do better than we did ourselves last year. It also needs to be very well aligned with what the business's strategy is and their competitive advantage. The classic example I've used with you before, Peter, is that the culture that's right for a retailer like a Costco or something, where the adage happy employees mean happy customers mean happy shareholders, where that prevails, that's not necessarily the right culture for an industrial company like a railroad or something like that, where the goals of the company, the competitive advantage it has, are different and need a different type of people. So we want them to be aligned as number one. We want them to be adaptable. That's number two. And the third one, we want to find out that the culture is actually permeating the organization. Remember, we talk about culture as the behaviors that the people do, the things that motivate them. And sometimes around here, we say it's what the people do when the boss isn't looking. If that culture is right for the business, then we've got something. If it's strong throughout the organization, it's adaptable, and it's aligned. And that's what we find is the secret to finding what things about the culture that we want to know.
And that was Kurt Winrich from WCM. Now, if you're not a subscriber to our show and you're watching it, please become a subscriber. It really helps us. The bigger the numbers, the more popular we look, and the more people have to watch us. And we can get the best guests then for you, so you can get some great insights to make lots and lots of money. So become a subscriber, make your friends and family become subscribers, and we'll all do well together. Thanks for joining us. I'll see you next week.